There's a lot of talk these days about variable annuity pension plans, also called VAPs. That's because a VAP has significant advantages over today's predominant plan designs, 401k type plans, and traditional pension plans. A VAP provides lifelong inflation-protected benefits to participants, but employers get to make contributions like they would to a 401k plan. You may be wondering how the VAP is able to do this. Well, let's compare VAP funding to a traditional pension fund. Let's start with a traditional pension plan. It likely started many years ago in a pre-PPA world. And in that world, the liabilities were measured using an assumption that a balanced portfolio is expected to achieve over a long time horizon, like say 7%. As the benefits accumulated, liabilities grew. Liabilities increased with new accruals and decreased as people retired and drew their benefits. For corporate plans, since PPA, liabilities have been measured using a bond yield curve, and the liabilities have been volatile, much more volatile than shown in this graph. When you look at the growth of this plan, it is a little scary. It now has liability for 3 generations of participants. The plan has become huge. In fact, the size of many pension plans has come to rival the size of the company. This can be very difficult for sponsors to manage. The pension liability behaves like a bond, but the portfolio backing it typically does not. Most pension plans invest in a balanced portfolio, meaning a mixture of stocks and bonds and potentially lots of other things. And so as asset returns are volatile, the value of the assets bounces all over the place. You can see the big run-up of the 80s and 90s, where the assets diverge up from the liabilities. Then the dot-com bubble, when the assets dip back down below the liabilities. Then the big dip in assets towards the end is the credit and housing crisis of 2008, followed by the Great Recession. This mismatch between assets and liabilities results in a volatile funded percentage. We're measuring funded percentage as assets divided by liabilities, and the funded percentage is quite volatile. And when it dips below 100%, as happens several times, it causes significant contribution volatility. The contribution requirements then vary significantly from year to year, which can be a problem for sponsors. One solution to this volatility would be to invest the plan's assets in bonds, which would make the assets and the liabilities move together better. But since bonds are expected to earn smaller returns over time than a balanced portfolio, this strategy results in larger contribution levels, stable, but larger. In a VAP, we can have both a balanced portfolio and stable contributions. The VAP assets are invested in a balanced portfolio. You can see the same asset accumulation pattern as in the traditional plan. This is what the assets would have looked like for a plan that was in a VAP for many years. But the liability side is different than in a traditional plan. The VAP benefits move up and down with the investment returns of the plan. So when asset returns are high, benefits go up. When they're low, benefits go down. This keeps the liabilities in step with the assets, and the plan stays funded. You can see the liabilities are always a bit below the assets, and the plan is always over 100% funded. This prevents contribution volatility for the sponsor. The obvious question, though, is why would we put in a plan that has benefit volatility for retirees? We wouldn't. We stabilize the plan with a reserve. So in a stabilized VAP, in the years when the returns are particularly high, a portion of the upside doesn't serve to increase benefits, but instead it builds a reserve. Then, when returns are low, a portion of the reserve is spent to prevent retiree benefits from declining. The reserve is the difference between the assets and the liabilities in this chart. The result on funded status is that over time, the plan stays over 100% funded, hovering right around 115%. The bump out near the end of the graph is the 2008 crisis, and you can see that the plan was easily able to shore up benefits without any funding problems. In fact, the reserve would be sufficient to prevent benefits from declining even through the Great Depression. So participants get lifelong benefits that are expected to rise over time without benefit decreases, and sponsors get stable contribution requirements like a 401k plan. The VAP is a total win-win. For more information on the comparison of the benefits provided by VAPs, traditional plans, and 401k type plans, see our benefits side-by-side video. For general information, you can go to milliman.com